Part 2, we're ready to launch into our budgeted income statement. We've completed our cash flow. All right, working our way through these bullet points. First point, all inventory is purchased on credit. This has no impact on the income statement because there's no revenue earned, there's no expenses incurred. Similar with payments to accounts payable. This did impact our cash flow, but again, no expenses incurred, so therefore it doesn't appear in our income statement. Cash sales, credit sales, returns, these are all part of our trading revenue. So we're going to report these at the top of our income statement. 40K for our credit sales. And then we're going to deduct our sales returns to work out our net sales. Okay. Net sales, if we add those two up and then subtract the 2K, we're going to end up with 48K. All right. Expected receipts from accounts receivable got reported in our cash flow. It doesn't affect our income statement. These relate to the credit sales. Allowance for DOB debts. Now, normally we'd have to reconstruct this ledger to work out our bad debts expense. I'm trying to keep this video brief. It's introductory. So spoiler alert, we know that it's $700 based on the information at hand. That is a non-trading expense. So therefore we put that down the bottom of our income statement. Discount revenue, that's non-trading revenue. It doesn't relate to the sale of inventory. So that goes in our other revenue section. So discount revenue that we've received from our accounts payable for promptly paying them. Discount expense is also a non-trading expense. So these would have been granted to our accounts receivable for paying promptly. Inventory loss, inventory write-down. These appear between our GP, which is our revenue minus our COGS, and our adjusted GP. So we're going to less the inventory loss, and we're going to less our write-down. So these were part of the Unit 3 course. Alrighty. So we had 400 and 250. So let's just do a little subtotal of 650 there. We'll subtract that later. Then we have our cost of sales. So that's our first entry in our COGS. So we've got 23,350. Drawings, due to the entity assumption, does not affect our income statement. So we've already dealt with that in the cash flow statement. But there's more. Now we get to a depreciation calculation. We've bought some shop fittings during the year. We've been told to use the straight line method, so we need to use our formula. So I've just plonked that down the bottom here. So our numerator is our cost, which was 40K. And then we minus our residual value, 8,000. And then we divide that by our useful life in years, which is 4. Okay, let's just center that up. All right, so using the magic of Excel, let's just work that out, that if we go 40K cost minus 8K RV, and we divide that by 4 years, that equals $8,000 per annum. But what we need to be mindful of is, did we own the asset all year? No, we didn't. This budgeted period is a full year that ends on the 30th of June. We purchased the asset, it says it right here, at the start of April. So that means, use your fingers, we've had it for all of April, all of May, all of June, 3 months. So we need to multiply this 8,000 per annum by 3/12, a quarter of a year. So easy way to do it, so is just to literally go equals 8,000. We could divide it by 12 and then multiply it by 3, or we can just divide it by 4. It's a quarter of a year. 2 cray. So that's going to be our depreciation expense for our shop fittings. So be careful with your date there. That relates to Area Study 1, Unit 4. Next point. The vehicle is depreciated at 25% RB method. So now we need to look at our NCAs in our balance sheet. And if you look at our vehicle, less our ACDEP, our carrying value is 40K. So let's just use the magic of Excel here, depreciation on the vehicle in our other expenses, and we're just going to type in equals our carrying value, which is 40. We're using the RB method, and we're going to multiply that. We've had it all year by our RB percentage, 0.25, 25%. And we end up with 10K. Next point, 4,000 payment for prepaid insurance. We recorded that in the cash flow statement. The balance at the end, that'll be important when we're doing our balance sheet, part 3, but we've worked out that we've got a 3,800 expense. The reason why it's not the same as the payment there is because we've got a balance at the end, and we had a balance at the start in our prepaid account there, $1,000. So there's a $200 discrepancy between our ending balance, hence that $200 discrepancy between our payment and our expense. So we go with the expense figure. Insurance, not prepaid insurance. Prepaid insurance is an asset. So 3,800. Okay. Similar story with wages. We did have some accrued wages at the start. We've also got some accrued wages at the end. There's a $150 discrepancy between the amount that carried over from the previous period as a liability to what we end up with. So again, that $150 discrepancy is reflected by the wages paid, which we report in our cash flow, and the amount we expensed. So the amount we expense is what we put in our income statement. 14,350. Then we've got some commission revenue. So again, if we look at our balance sheet from the previous period, we had some accrued from the previous period. And so therefore, again, we're going to get a bit of a discrepancy between what we receive and what we earned, given there's a $600 amount. So again, there's a $200 difference between our accrual at start, $200 at the end, and so therefore we get that $200 discrepancy between the amount we earned and the amount we received. We're interested in our income statement with the amount we earned based on the accrual basis assumption and the period. Now this is other revenue, it's non-trading, so we're just going to record that as commission revenue. For our earned amount, $2,700. Okay, we can, so now we've got a loan taken out on the same day that we bought the fittings, and we've got a $40,000 loan, and it says here a couple of points later that we're paying 6% on that interest. So therefore we need to calculate, a bit like depreciation, we need to calculate our annual interest expense, and then we need to multiply that by a quarter of a year because we've only had the loan for a quarter of the year, April, May and June. So let's use the magic of Excel to work this out. So we've got 40K. We multiply that by 0.25 and we get $10,000. Sorry, take 2, 40,000 times 0.06 equals 2,400, and now we need to divide that by 4, quarter of a year. So it's 200 a month times 3 equals, let's see, 800. Sorry, I need to divide that by 4, quarter of a year, 600. So plonk that in your other expenses, interest on loan, 600, nearly there, crew. Okay, so then we've got some GST transactions. These do not affect the cash flow statement. So now we're in a position to work out our net profit. So let's start by working out our GP. Our GP is our net sales minus that cost of sales. Then we're going to work out our adjusted GP, which is our gross profit minus those two losses write-downs. And then we can add our other revenue. So let's just work out a subtotal here. That's 2,900. And then we'll do a little subtotal underneath. Make sure you add the other revenue plus other revenue. And then we need to sum our expenses, our non-trading expenses. And therefore we end up with a net loss. Okay. Keep that in mind for the balance sheet.